Well, if investors in the IT space were hoping for not there being an encore from amongst the top tier IT companies, HCL Tech has come to the rescue. Splendid performance on the bottom line, large deals won in the quarter as well, so that run rate continues unabated. What happens in terms of how the revenues shape up and what happens in terms of deal wins, the operational metrics, so on and so forth. The top management of HCL Tech, as always, join us right now on earnings call. Gentlemen, thanks so much for having us, and good to have you. Vineet, it's been a good quarter, and considering the kind of circumspect behavior that at least a few people had in their minds about how the IT space would do as a whole, you guys have come out there and shown, put up your hand, the bottom line performance splendid. More importantly, the deal wins have been stellar this quarter.
I think so. If you look at not only this quarter, which is 14.6% up in revenue, but in the last 12 months, it is about 22% year-on-year growth. And EPS growth rate of 38% year-on-year on a last 12-month basis is actually phenomenal performance. And if you combine that with a historical high, we have never ever seen a $1.5 billion plus large deal signature across 12 customers. And that is basically each deal is greater than $100 million. And $2.5 billion over the last 6 months makes it a fantastic run for 6 months. And therefore, not only we are happy for revenue delivered and margin expanded, it is the second consecutive quarter of margin expansion, but also very happy that our order book is looking extremely good.
Since there are so many positives, and I'll come to all of them in a bit, I remember how gung-ho you were at the end of the last quarter when you signed a $1 billion deal size, total deals, and you've exceeded that. But just one quick thing out of the way. Because of what the currency is doing, and I'll come to Anil on that in a bit as well, the rupee revenues have been just about flattish. You were expected to go around 2.5% to 3% higher end of all the peers that you have, and in dollar terms, you've pretty much done that. You think that could be a concern, if at all, in the next couple of quarters or 3 quarters?
I don't think so. See, in the end, what the company is concerned about are 2 things: growing market share and growing EPS share. So if your last 12-month EPS or this quarter EPS has grown 18-19% year-on-year, and last 12 months have grown by 38% year-on-year, that is what matters, because that nets off all currency issues there. And on revenue, our dollar revenue have grown up by 2.5% because we sell services in dollars. We don't sell services in rupees. So translating dollars in rupees doesn't make sense.
Sure. Okay. But you at least believe that the revenue inflow will not have any kind of material impact irrespective of what the currency does.
No.
Great. Let's talk about the big thing we need this quarter, and that's the quantum of deals that you've signed. And the reason I'm asking this to you is because there were a couple of, indifferent or rather polarized views that came out. Accenture, for that matter, or Oracle, when they came out with the numbers on the financial statements, expressed optimism. Accenture, in fact, upped the guidance as well. But Gartner or the TPI call did suggest that the deal flows or the deal sizes will trickle down drastically in the first half of this year. Your deal signings don't seem to suggest that.
I think if I take a few minutes to explain this, sure. Right? So the first is, let's talk about the $2.5 billion deals which we have signed. $2.1 billion is from Fortune 500 customers. So that is one indication that the maximum buying is happening in the Fortune 500 G2000 category. Number 2, $1.4 billion is from financial services, and $1.1 billion is from manufacturing. So therefore, all the financial services, which is completely restructuring its cost because of the macroeconomic indicators, is actually joining the party in vendor churn, and same is true with manufacturing. Europe is again growing at a phenomenal rate at $1 billion plus, and same is true with US. So therefore, what is happening is in the developed economy, people are positive about the future, optimistic about the future, and are restructuring their cost so that they can save money to be able to drive CTB spending. If you really look at our EAS growth, it is the second consecutive quarter where we have grown in excess of 4%. And actually, in the last 6 months, it is our fastest growing service line, which means that, and we have to live quarter by quarter, it means that the CTB spending, RTB saving is being spent on the CTB. Having said that, let me put a caution in the wind. The caution in the wind is the TPI data is correct when they projected that the H1 is going to be muted. Right? So we have announced Q1, and I think it is because of a large win ratio. Our bid to win ratio has been extremely high this quarter, because of which I think our deal announcements are pretty large. But I do agree that after this quarter, we're going to see muted growth, and we are okay with it because we have an order book. And therefore, you are not going to see such large deal announcement, at least from HCL, and as per TPI rate, as what TPI says. And also on an overall IT spend, you're not going to see an increase in overall IT spend, and therefore it will continue to be market churn, which will drive growth for various vendors.
You know, at the end of last quarter, you also mentioned that you will not announce significant deal wins this quarter, and you've done exactly the opposite. So I'll quiz you more on that in a bit, Vineet. But Anil, come to you. Despite the currency volatility, and it was very volatile, you seem to have done okay in terms of how to manage the margins per se, despite the currency fluctuations. The question mark really is, what you've shown this quarter, is this something that is sustainable for the next quarter as well, given what the rupee is doing?
So, as Vineet just mentioned, that we have been able to maintain our margins at 15.7% in spite of the 90 basis point headwind on account of the currency this quarter. But we are not giving any guidance, so I'll stay away from giving you a number. But we have been sort of performing well.
No, without getting into a specific number, but what I'm just trying to figure out is that with currency doing what it is doing and the cost picture being what it is, do you think that you'll at least be able to sustain the kind of performance that you've shown? Let's not get into a specific number. Is the currency a big headache, and will you be able to manage it, is my essential question.
So the currency we are managing through a layered hedging program. So we follow that 40% of our inflows for the next 1 year we hedge. We took a charge last quarter of something like 14 million, and this quarter it was 7 million. So it reduced significantly. Currency is volatile, so that's how we manage it in that environment. So far our management has been good.
I think it's one of the variable elements which you will have to learn to manage and live with. I think it can no longer be an excuse. It is a variable, and I think it's here to stay. The currency fluctuations are here to stay. And therefore, layered hedging or whatever formula you adopt has to be thought through and adopted, because this is the reality. You can't wish it away.
I want to come to Anant on a sector or a space rather, or the field that didn't do too well last quarter by virtue of what happened to the currency and by virtue of how you guys were probably in a pause mode in India. You've bounced back quite smartly. What happens? I mean, give us some color on how the quarter went by.
Sure.
And what happens in the quarter ahead.
Sure. So if you look at Q3, I think the first big highlight is, the infrastructure services revenues crossed $1 billion on an annual run rate basis. So which is a good milestone going forward, which kind of puts in together whatever we've been doing in the past. I think the second thing really is all about the bookings, which, and the order pipe, which Vineet mentioned. I think that has been a significant play. So it's a window like 2008. We said we will focus our energies on trying to capture market share, given the fact that the spend is not going up. Therefore, let's capture whatever is, shift in the market share and really fuel the forward-looking growth from that perspective. So if you look at the last 2 quarters, similar to the company, we've signed in excess of $1 billion in contracts in this space. So it obviously gives a high quality of revenue. The further addition to that is really it's coming in from a high quality of customer profile. The Fortune 500, which Vineet mentioned, obviously is a good play for further expansion as we go along. So I think these are 3 key messages. If you look at the sectors, the financial services, while the overall spend is not going, but there is a significant churn in there. The large financial institutions are looking at, a more optimal strategy so they can unlock their capital for transformational investments, so that could affect the business. If we look at the media and entertainment industry, again, there is where we're seeing a significant churn. And finally, the manufacturing sector, again, with its globalization, we're seeing that. So I would say, all in all, the window of opportunity was good. I think we have made a significant booking from that market, and I guess that's what we'll see going forward from a realization perspective.
Yeah, but the moot question, Anand, is that what Vineet was referring to in the last quarter as well, that by virtue of what the currency did, you guys did enter a pause mode in India in particular, and that impacted how the division performed.
Sure.
How do you think, is there a possibility that such a thing could happen again because the currency is very volatile in the quarters ahead? Or do you believe that the run rate that you've shown this quarter would continue?
I think the India story is behind us. I think whatever needed to be done from a contract perspective has been done, so it's really behind us. I think we'll see the impact of its billing into next quarter. So I would really say it's largely behind us, and we don't see that impact really coming into the quarter-on-quarter performance.
So confident of the run rate continuing.
Sure.
Okay, Vineet, I just want to come back to a point that you made earlier, that maybe this quarter will not be as robust for the industry and for HCL Tech. Let's talk about HCL Tech in terms of deal signings. The point that I was trying to make is that in the next, okay, great. Yeah. Okay, so with respect to that, if I'm not wrong, the relative share of the restructuring deals in the overall mix, I think, rose to some 43% versus 32% on a quarter-on-quarter basis. You stated in the last quarter that around $47 billion worth of deals are up for grabs over the next 12 months. Do you fear that there could be uncertainty in client decision making which could lead to this, or do you believe that the overall deal flow per se will slow down considerably?
I think there are two aspects to this. Number one is, I think the $47 billion is a real number, and 30% of that will churn. So we are talking about $14-15 billion will change hands. TPS sticks to that number, so do we. We believe that's going to happen. As for TPS estimate, that is backloaded, which is October, November, December loaded, and we believe that's going to happen. So October, November, December seems to be going to be a big deal quarter, October, November, December of 2012. Having said that, from an HCL point of view, after doing $2.5 billion, I think we have to step back and consolidate and focus on execution rather than new deal wins. And therefore, there is a part strategy within HCL, which is what I said in 2008, that when the window was open in October, November 2008, we jumped in and we did the $1 billion, and because of which we were able to sustain the momentum with us through the recession, which is what we have done now. And I think for the next 2 or 3 quarters, it is time for us to put our head down and execute rather than focus on new deals. And therefore, we will come back, I think, in the market for chasing new deals starting somewhere in August, September, and winning in October, November, December. That's the overall strategy, because this kind of book we have never won before. And therefore, it is very important that all our management focus goes in execution. And that's what you will see from HCL's point of view. On a macro basis, I truly believe that the deal pipeline is continuing to grow from a churn point of view is because existing customers are unhappy with their vendors, and that is driving deal churns. And this quarter announcements which we have done, the very fact that the $1 billion in financial services from Fortune 500, G500 customers is giving you an indication that the unhappiness is not just with small customers. Very, very large customers are doing vendor consolidation and vendor churn because they're unhappy with their existing relationships. And that's a threat for few, and that's an opportunity for some. And we believe it's an opportunity for us.
Oh, yes. But you're sounding content, which is a good thing, Vineet, with the deal signings that you've done. Before we come into a couple of other things that have happened in terms of the BPO as well, and I'll get Rahul in on that, just a word on the geographical, how the different geographies have shaped up. And this time around, let's start off with Europe, because that's been a strong point, and it continues to remain so for you in terms of the growth area.
I think that's an interesting question, and my commentary on this is a bit changed after talking to a lot of people in this quarter. So what I've understood is that U.S., let's start with U.S. U.S. has 20% higher profitability today in our customer base compared to what it was in pre-recession. However, their capex investment is 1% lower than what it was pre-recession. So what has happened in U.S. is that the companies are doing well because they are more globalized. However, they are spending less because they want variability, and they are getting more revenues at lower margins, especially because they're focused on emerging markets. And therefore, their trajectory of IT spending is going to constantly be low. Number 2 is financial services was a very large part of U.S. economy, which is seeing huge margin pressure. And because of which the IT intensity in financial services is going to come down on run the business, and they have to fund to change the business to continue to be competitive. And therefore, in the U.S. economy, you're going to see a flattish or a negative IT spend, despite the fact that the macroeconomic indicators on financial performance of the company are going to be good, but they're going to be very astute about how they're going to spend their capital investments. When you come to European...
So if I can just interrupt you there, in which case the performance that has been shown in this quarter on quarter, America has been soft and financial services have been soft as well. You think that's probably other things remaining constant here to stay for the next couple of quarters?
No. What has happened is, so let's talk about from a macro point of view, it is here to stay. Right? And therefore, if you see the financial services performance for us and some of the other results which have been announced for the last 4 quarters have been flattish. But that is not going to be for us going forward because we have got $1 billion of book of business, both in financial services and U.S. But for the macro, for the industry, the answer is yes, predominantly because IT intensity is going to be low and the churn is going to happen within the vendors. So therefore, overall spend is not going to go up. So the opportunity in U.S. will be for people who are going to win the vendor consolidation and vendor churns.
Okay.
If you go to Europe, it's interesting that the profitability of these companies are actually historically lower than it was pre-recession, unlike the U.S. And therefore, their IT spend cuts are because of the profitability concern. And therefore, they are a lot more ruthless. And they are first-time outsourcers. And therefore, the market opportunity in Europe is significantly higher because first-time outsourcers are easy to convince, whereas churns are more difficult because of transition involvement. And therefore, you are seeing a huge amount of traction in Europe. And Europe, hence, is a very attractive market for first-time outsourcers. And therefore, dynamics in Europe is very different. And therefore, 2 markets are going to behave very differently.